Hey everybody, I'm John Cervantes, back with another edition of the Practitioner's Brief, and today we're talking bonds and what to do with them in 2026 and beyond. But before we get there, I wanted to spend a few minutes and talk about what's been going on in markets the last couple of weeks, and I think it really sets the stage for everything I'm going to discuss. So it's February 16th, and we are officially in the middle of what I would describe as AI disruption repricing. So not a single event, but more of a sequence, and it's been moving fast. And I think this really started to kick off in late January when an open source agent project called OpenClaw went viral. And the significance wasn't the product itself, it was more of the proof of concept. Fully autonomous AI agents, self-hosted, running 24/7 for free, got a lot of people's attention. And it showed that a lot of these large language models are kind of commoditized. They can be interchanged and swapped out. And the true value was in the orchestration and the autonomous execution of these AI agents. Many private large language models like OpenAI, Anthropic have expected funding rounds in 2026, and there's also hints of IPO activity. So it's not a coincidence that these models started dropping a lot of workflow plugins. And yesterday on February 15th, Peter Steinberger announced he was going to work at OpenAI, where he's going to start the next generation of personal agents. So it's big news and just further reinforces how fast the perception of the value in the AI ecosystem can change. So on February 3rd, Anthropic dropped a legal workflow plugin that sent tops and rooters down 18%. On February 10th, a fintech called Altruist dropped an AI tool called Hazel, talking about tax planning. This isn't new. Hazel's been around. I learned about this in December. Despite that, brokerage stocks sold off. Raymond James, Morgan Stanley, Stifel, kind of across the board. We saw a sell-off in insurance companies. We saw a sell-off in commercial real estate. Fewer workers means less demand for office space. We saw it in logistics, and trucking, and freight. And I think we're going to continue to see this volatility as AI and its ability to disrupt a particular industry gets priced into markets. But a lot of it's still speculative, kind of a shoot first, ask questions later. But I think this does go back to a lot of what I've been writing about for seems like several months now, is continuing to think about that barbell structure, thinking about, okay, we need to have that forward looking view on technology. It's important, has to be incorporated into the portfolio. But also the legacy, difficult to replace businesses that are responsible for a lot of the aspects of our lives and that have a really difficult, or I have a really difficult time seeing AI replacing an energy pipeline distribution network, a metrolysis factory in Tennessee that recycles very hard to process plastics, a global brewery and distribution network. And so it's, how do we construct a portfolio that is forward-looking, factoring in the exciting technology, but is also ballasted by high-quality, high cash-flowing businesses that are difficult, if not impossible, to replace through artificial intelligence. And in fact, AI could even make these businesses more efficient and help their margins expand. So that's what I've been thinking about over the last couple of weeks, and I'd expect this volatility to continue. These periods of volatility don't just stop, they need more of a washout. But I do think volatility provides opportunity, and that's the best way to think about it. We've been seeing just really strong broadening in markets, and I've spoken about that over the last few months. So, but let's drop into bonds. I really wanted to pick up on the Back to Basics series I started last month, where we talked about the S&P 500, and I really wanted to touch on what do we do with bonds, not just in 2026, but how do we think about them currently today and beyond? Currently, we're looking at a 10-year treasury at a little over 4%. We have CPI or inflation sitting at 2.5% or so. And after inflation, we're looking at a little over 1.5% real return. And if you're a taxable investor or holding your fixed income in a taxable account, you're still paying taxes on that 4%. So not exactly attractive. But before we get into some specific perspectives, we need to talk about how we got here. And in my view, the bond market has fundamentally changed. And if we think about bonds from a historical perspective, they've primarily served two roles, one being income and two being a volatility dampener. When stocks fall, investors flee to safety, buying bond, pushing rates down and prices up. That negative correlation is what has made the 60-40 portfolio work, specifically after the post-financial crisis. But in January 2022, we entered a structural bear market and rates rose pretty aggressively in response to inflation that followed after the COVID-era spending. Now, the Federal Reserve has cut short-term rates, but long-term rates have stayed pretty high, really hypersensitive to any headlines on inflation, geopolitics, the country's debt and deficit dynamics. And then we've added a geopolitical layer on top of this. We have weaponized the dollar in response to Russia's invasion of Ukraine. We're using tariffs as geopolitical leverage. And politics aside, these things do have consequences for the bond market. If we take a step back and look at performance since January 2020, the start of the decade, bond indices generally have returned less than inflation. Commodities and precious metals have crushed fixed income. So the traditional safe haven hasn't really been safe, especially factoring in inflation. So where do we go from here? I think there's really two paths, and the AI disruption I was just talking about, I think plays into both of them. There's a bull case. That's one where AI delivers real productivity gains, and not just for the big technology companies. What we've seen in the past 2 weeks with AI reaching into legal, financial services, logistics, it's just accelerating competition. It's going to accelerate disruption. And that's good for the economy. Higher nominal growth drives higher tax receipts. This shrinks the deficit organically. And then the US has a really credible case that it can outgrow its debt burden. So this could reprice interest rates lower, interest costs fall, and this creates a virtuous cycle. And I believe this is what Scott Bessent is trying to engineer alongside newly nominated Fed Chair Kevin Warsh, putting together a so-called Fed Treasury Accord where we sync deficit funding with monetary policy to reduce the country's interest burden. So that's what I think Kevin Warsh's nomination signifies, and I think Scott Bessent had a big hand in selecting him. So in this scenario where we get this big productivity inflection, for me, it's very bullish for equities. Bonds do well because inflation comes down and rates come down. But in this scenario, you're going to look back after 10 years and wish you owned a lot more equities. More of a bear case is all this AI capex turned into a bust, or the disruption, kind of like the disruption we're seeing now, destroys value faster than it can be created. And in this case, the K-shaped economy, which is very tied to the equity markets, the haves and have-nots, so to speak, higher income consumers pull back. We end up with a recession. The country's balance sheet leaves little to no margin for error. So tax receipts fall, deficit widens, and instead of interest rates coming down in a recession like we've seen historically, they go up, because the market is pricing in a debt burden or maybe even an increasing debt burden. And this requires the Fed to get creative, possibly with some sort of yield curve control. In this scenario, inflation stays elevated, bonds get hurt, stocks get hurt too in this scenario, but there's no real preservation of purchasing power in bonds. And in real life, this isn't as binary, and we'll probably land somewhere in between these two scenarios. But I think the point here is that in either scenario, there's just some structural headwinds for fixed income investors. In my opinion, a 4% 10-year treasury doesn't compensate you for those types of risk. And that explains why the precious metals complex has been moving so aggressively higher. It's factoring in a lot of these risks. And it's not just individuals and institutions factoring in this risk. It's global governments and central banks. And that's really why we've seen such a strong rally in metals, precious metals specifically, in my opinion. So should you own bonds? Yes, absolutely. I just think it has to be strategic and purposeful. We want to tie bond holdings to specific financial objectives. The fear of equities or the fear of volatility is not enough of a reason. So I think if you have expenses 5 years out or within 5 years, like tuition, home purchases, bonds provide certainty, and by matching the maturity to the expense, You know what you're going to get. And for retirees, bonds serve as a rainy day fund. 3 to 5 years of living expenses in high quality bonds. So if equities drop 20, 30, 40%, you're not selling stocks at the worst possible time to cover your bills. Draw down your safe haven bond assets, replenish when the markets recover. It's a decent strategy, but there's also a lot of nuance. The longer your time horizon, the riskier bonds become, and not necessarily to your principal, but to your purchasing power. Inflation erodes the real value of those fixed payments year after year. And so I wanted to close with something from my work Bible, Jeremy Siegel's Stock for the Long Run. And Professor Siegel makes a point that I've internalized, and I think most investors should. He says it's very significant that stocks, in contrast to bonds or bills, have never delivered to investors a negative real return over periods lasting 17 years or more. Although it might appear to be riskier to accumulate wealth in stocks rather than in bonds, over the long period of time, for the preservation of purchasing power, precisely the opposite is true. The safest long-term investment has clearly been a diversified portfolio of equities. So conventional wisdom says stocks are risky and bonds are safe. And yes, that's true over a year or 2 years or 3 years, but over long periods of time, preserving what your money can actually buy, the data says it's complete opposite. Now, if you've read, watched, or listened to my update on the S&P 500, I questioned, is that still a diversified portfolio of equities? So there's a lot of nuance still to the conversation. But for me, generally, shorter dated laddered fixed income structures that are appropriate for our client's financial plan seems to be a reasonable approach. If any of this resonated to you, you'd like some additional perspectives, reach out. Thanks for watching. Have a good day.